Hey there, welcome to this video on Bank Collapse 2023. You might be wondering, why would anyone want to watch a video about banks collapsing? Well, let me tell you, it's not just about the doom and gloom. Understanding the potential for a bank collapse can actually help you prepare your finances and investments. Past performance is not necessarily indicative of future results, and any person acting on the basis of such information does so entirely at his or her own risk. Trade brokers DMSA will not accept liability for any loss or damage, including, without limitation, any loss of profit which may arise directly or indirectly from the use of or reliance on such information. What is SVB? Silicon Valley Bank was an American bank that was one of the top 20 largest banks in the United States. It was the largest bank in Silicon Valley by deposit size. As the name suggests, the bank focused on financing startups, called startups. SVB financed business incubators that were responsible for projects such as Airbnb, DoorDash, and Dropbox. Silicon Valley Bank's strategy was based on a risky play with risk-free assets, government bonds. So what happened and what is now being addressed? Complications with withdrawals arose as startups sought to improve their liquidity position due to the worsening economic situation. One of the reasons for withdrawals of previously deposited deposits is to use the money for operations, as the current high interest rates make it impossible for startups to increase their debt. In fact, the US Fed has been raising interest rates at a very high rate over the past year. From 0.00 to 0.25%, interest rates have reached the current 4.50 to 4.75%. Due to the rise in interest rates, the market value of existing bonds fell, which banks normally booked as an unrealized loss. Why did SVB go bankrupt? The Silicon Valley Bank story is considered the biggest bank failure since the financial crisis. In recent years, banks covering this part of the sector and the firms themselves benefited from the cheap capital that flowed into the financial markets. At the time, SVB was accumulating deposits from startups, but macroeconomic uncertainty and financial problems forced these firms to withdraw their deposits. Over the past years, the volume of deposits has increased several times, and the bank had to decide where to deposit these funds. Yields on short-term bonds have been low in recent years, so the bank has opted for longer maturity bonds, which after some time has caused the problems with withdrawals that we see today. The bank deposited the money raised from startups in government bonds, which is a common practice in the banking sector. However, the problem arose when the deposits were withdrawn in bulk. SVB had to sell its bonds, incurring a loss due to their lower market than purchase price. This resulted in the management requesting a capital increase to make up for these losses. Past performance is not necessarily indicative of future results, and any person acting on this information does so entirely at his own risk. Is a crisis similar to 2008 looming? The current troubles of banks dealing in cryptocurrencies or venture capital have one similarity to the 2008 crisis. It is the high interest rates that have caused the market price of the security to fall. The key difference is the type of asset held. Whereas in 2008 the bank crash was caused by a fall in mortgage-backed securities, now it is a fall in standard government bonds, which can be sold more cheaply on the secondary market. Mortgage-backed securities were not as safe as the rating agencies indicated, because at that time anyone could get a mortgage. Can other banks benefit from the current situation? Government bonds held by failed banks will start to be sold off on the so-called secondary market, where any other bank can buy them. The advantage of these assets is their lower price. Banks that have a low loan-to-deposit ratio can afford to invest in additional deposits. The current situation is thus particularly interesting for the largest U.S. bank, which is J.P. Morgan Chase. M&T Bank or Citigroup may also benefit from the situation. What will the Fed and other institutions do to calm the situation? Not all investors remember the troubled years of 2008-2009, but those who do know that it was a truly huge problem that could have completely disrupted the financial system at the time. We assume that the U.S. Federal Reserve or other government institutions have learned from these events and would not allow the situation to go that far today. Theoretically, the Fed could cut interest rates more significantly, which would resolve the situation, but this would give up the fight against inflation, or the Fed will be much more cautious in raising rates. The markets have already started to price in this situation, which has caused bond prices to rise significantly. The investment bank Goldman Sachs even says that it no longer expects the Fed to raise rates further. There is also an FDIC institution within the US that insures bank deposits up to $250,000 per depositor. The problem with this bank, however, is that it had a large number of companies with higher amounts in their accounts, and there were concerns that the bank would not stop withdrawals, which was justified, so the FDIC had to look for other solutions. SVB basically had two options to address the situation. The first is to sell the bank, which is complicated for a number of reasons. The second option is to sell off parts of the bank to other banks. The money made would then be used to compensate depositors and other affected parties, and it could easily happen that all parties involved would receive a very large part of their money. By all accounts, the bank's assets are fine, and the main problem has been the fall in bond prices due to rising rates, so there should be no problem selling most of the assets. This is one of the differences from the troubled years of 2008-2009, when banks held huge amounts of very poor quality assets such as subprime mortgages. In this case, however, the FDIC has taken over the management of the bank and the assets and will ensure that clients are compensated. The institution has announced that all SVB depositors will receive their money in full, which should greatly alleviate concerns. Even US President Joe Biden has already promised that US citizens and businesses can be assured that they will get their money. The Fed itself has also introduced its own measures to alleviate concerns, allowing banks, through its program, to hold bonds to maturity for a certain period of time, in return for which the Fed will give them money at the purchase value of the bond. The authorities are therefore doing everything they can to ensure that the problem does not spread. However, the situation is evolving by the day, and it is possible that further measures will be added to prevent a greater panic. Has anything similar happened in the past? A number of institutions have faced similar problems in the recent past. We can mention, for example, the FTX crypto exchange. In its case, it turned out that the company probably lied and misled investors and invested money in various risky crypto projects. However, the whole case was kicked off by the CEO of rival crypto exchange Binance, who announced that they had conducted an internal audit that found several irregularities. Based on this, Binance sold a large amount of cryptocurrencies created by FTX, which caused a panic. This subsequently triggered a wave of withdrawals from the exchange, which, however, ran into trouble not only because of its high-risk assets, but also because FTX also had some of its money stored in government bonds. However, as in this case, their prices began to fall, so that the exchange had to sell them at a loss. Such panic withdrawals are referred to as bank runs. A similar event can bring down even a strong and healthy financial institution, because banks usually hold only part of their money in the form of cash. In fact, banks know the approximate amounts they need to maintain in liquidity for their day-to-day operations. But a run on a bank tends to break that balance completely, and withdrawal requirements usually increase many times over, putting the bank or other institution in trouble. Even Silvergate, a bank linked to the FTX crypto exchange, ran into trouble some time ago. Ironically, these problems did not stem from the fact that these institutions were engaged in riskier activities, but the problems started because of the multiplying withdrawal requirements that were problematic for them due to rising interest rates. What can this case do to the US stock market? The banking segment underwent a very significant transformation after the 2008-2009 financial crisis. Banks had a lot of responsibilities, they had to hold more capital, they added risk management staff, and banks were under much more scrutiny. The new rules and regulations were designed to ensure that a similar problem, which would then be suffered by society as a whole, would not arise in the future. However, by tightening the rules, we have reached a paradoxical situation where compliance is so complicated and costly that it increases the barriers to entry into this market. This is why the large banks have been increasing their market share for a long time. Although the available figures vary slightly, around 30 years ago the largest banks had a market share of around 15%, whereas today they have a market share of over 50%. We expect current events to exacerbate this trend. The assets of troubled banks are likely to be taken over again by the big banks, and, if there is any tightening of regulation in the future to prevent similar problems, this will make it particularly difficult for new players to operate. This information was also given a few hours ago by US President Joe Biden, who announced further tightening of bank regulation. The tightening of the rules may thus ultimately lead to even greater market consolidation and the strengthening of the largest players. Why can this be paradoxically positive information for the stock markets? At first glance, this situation looks negative for the market. Such events usually bring panic to the market, which usually results in a fall in stock indices, and that was the case here. Indeed, at the end of the second week of March, the indices also weakened on the basis of the JSE information, as investors feared that there might be a systemic problem. In one day alone, the banking sector weakened by around 4%. Even if the problem is resolved and the situation has completely calmed down, there will still be a fear that there will be another problem elsewhere in the economy. We saw a similar panic in Britain a few months ago with pension funds. However, it is very likely that this situation will force the US Fed to reconsider its approach to raising interest rates, at least that is what the market developments and the Goldman Sachs statement suggest. It is possible that Fed officials will be more cautious in announcing further rate hikes. If this situation leads to the Fed raising rates less or not raising them at all and rather starting to lower them, this should be a positive signal for equities. Indeed, lower interest rates are positive for equity markets, and this situation could cause the Fed to moderate its rate hikes. The Fed's dilemma. The U.S. Federal Reserve is faced with the decision of whether to continue raising interest rates to slow inflation or to cut interest rates to support financial institutions. Jerome Powell appeared before the U.S. Congress and House of Representatives in the second week of March. In his speech, it was said, among other things, that the January macroeconomic data showed better results than the Fed had expected. The most notable surprise came from the labor market, where the number of jobs increased by 507,000 and the unemployment rate fell to 3.4%. Data showing a strong labor market was also released for the month of February, which puts the Fed facing a tough decision. While the market was pricing in a 50 basis point rate hike at the March meeting with a 71% probability after Jerome Powell's speeches, market expectations have been lowered following the bank meltdown. The swaps market is currently pricing in a 25 basis point rate hike at the next FOMC meeting with a 58% probability. In this wake, government bond prices rose sharply on Monday, with two-year U.S. Treasury yields posting the largest one-day decline since 1987. At the same time, two-year Treasury yields fell the most in 3 days since 1987. Thus, markets have begun to price in significantly lower rate hikes. That concludes our video series on the potential bank collapse of 2023. We hope you found this information helpful and informative. Remember to subscribe to our channel and check out our InvestGuide for more tips and advice on managing your finances. Thanks for watching.